All right, welcome to our explainer on Plazm. Today, we're diving deep into the critical data from day 70. Now, the headline is that the market is testing lower levels, but you really don't want to let that fool you. The underlying math is actually telling a much more interesting story, and we are here to break it all down.
And you know the drill. Just a quick heads up before we get started. This analysis is purely for informational purposes. Please always do your own research.
So here's the game plan for today. First up, we'll get a snapshot of the market right now. Then we're going to unpack this really surprising paradox involving the floor price. After that, we'll analyze the very first wave of unlocks, check in on the health of the yield engine, and finally, we'll look ahead to the big one, day 78. Okay, let's get right into it. Today is day 70, which is a pretty major milestone. And why is that? Well, because we are just 8 days away from the single largest token unlock in the protocol's history. This is a huge deal, so let's break it down. Okay, the number on everyone's mind today is, of course, the Plazm price. It's dropped about 20%, and it's now testing these lower levels right around 41 cents. But, this price drop isn't happening in a vacuum. If you look at the table here, you can see it's happening at the same time as a 13% drop in the price of eShare. And the overall market sentiment, it is firmly stuck in extreme fear. This broader context is absolutely crucial to understanding what's really going on under the hood. On top of all that, we're now seeing the very first wave of early stakers, the folks who got in between day 1 and day 7 start to cash out. And this is totally expected, and it's actually, believe it or not, a good thing. Let me explain why. So all of this brings us to the central and, well, frankly, the totally counterintuitive insight of today's analysis. I'm calling it the Widening Cushion Paradox. Just look at these numbers. It's kind of wild. Yesterday, the price was at 51 cents, and it was sitting 70% above its floor price. Okay, today, the price is lower, down at 41 cents, but the safety cushion above that floor has exploded to 128%. The buffer got stronger, even as the price went down. So you gotta ask, right? How is that even possible? How can the price fall while the safety buffer nearly doubles? It feels like it defies logic, but the answer is right there in the math. It all comes down to a really clean 3-step mechanical process. Think of it like a seesaw. First, the price of eShare dropped pretty significantly. Now, because the floor price calculation is tied to eShare, this caused the mathematical floor to fall way faster than the Plazm price itself. And what's the result? The percentage gap between the price and the floor just mechanically widens. These early unlocks are actually a gift. They're giving us a real-world preview of what we might expect, but on a much larger scale in just 8 days. It's kind of like getting a sneak peek at the final exam. So, what are we learning from this little dress rehearsal? Well, first, some selling at maturity is totally normal and expected. Second, the market is proving it can absorb this pressure. And third, and maybe most importantly, all the core protocol mechanics are just chugging along, functioning perfectly. And you can see right here, despite some people cashing out, the vast majority of Plazm holders are staying put. A full 60% of all Plazm is still staked, with another 25% providing liquidity. That shows some really strong conviction in the protocol. Okay, so this brings us to another area of stability that honestly often gets overlooked when things get volatile: the protocol's yield-generating engine. 9. That's the number. 9 consecutive days that the buy and burn USDC treasury has grown. It has operated flawlessly, day in, day out, through all of this market chop. That right there is the power of a well-designed protocol. And this strength isn't just in one metric, it's across the board. The total defense funds are up, over $360 in new profits were claimed by stakers just yesterday, and 18 new bonds were issued. This engine is built to work no matter what the price is doing, and the data is proving it's doing exactly that. All right, let's look ahead to the main event, day 78, and see how today's price action has actually de-risked that whole situation pretty significantly. Here's the key idea, and it's actually pretty simple when you think about it. A lower token price just slashes the total dollar value of all the Plazm that's being unlocked on day 78. The number of tokens stays the same, sure, but the potential financial impact gets dramatically smaller. Just look at this chart. The difference is staggering. At the peak price of 95 cents, that day 78 unlock represented over $2.1 million of potential sell pressure. Today, at 41 cents, that same exact unlock represents just over $900,000. That is a 58% collapse in the potential pressure the market has to absorb.
And that right there brings us to the single most important takeaway from this entire explainer. While lower prices absolutely feel worse emotionally, nobody likes seeing red, they objectively create healthier mathematical conditions for the protocol. You get a wider safety cushion and you get way less pressure from future unlocks. It's a win-win, even if it doesn't feel like it.
So what's the bottom line here? What does this all mean for you? Well, if you're patient and you're willing to look past the day-to-day price swings, the numbers are clear. The underlying math of this protocol is very much on your side.
Thanks for joining this breakdown of Plazm Day 70. The countdown continues, and as always, please remember to do your own research. The big question now is, will the market recognize the underlying strength here before Day 78? We'll have to wait and see. Catch you next time.